Hi, everyone. Good morning or afternoon, because I think we have some people in some different time zones joining us today. So welcome so much to our webinar, the 10 biggest myths in filing taxes for artists. Bit of a tongue twister there. My name's Isabella Bear. I've been with ATB for 10 years now, and I've been with the Branch for Arts and Culture since its inception 7 years ago. Like many of our team members, I have a background in the arts. I have my BFA, Bachelor of Fine Arts, and I worked professionally as a stage manager for many years. I'm also fortunate enough to be the treasurer for Latitude 53 Society of Artists here in Edmonton. I've also had some opportunities to work with different organizations in the city, like Edmonton Screen Industries Office. Really, it's my complete pleasure to host today's webinar and to learn some things with you. As I mentioned, I'm based out of Edmonton, but I'm curious to see where everyone's situated today. So if you're comfortable, let us know in the chat where you're joining from. And I'd also love to know what artistic mediums you're from, what kind of art gets you excited and that you work on. So I'm going to kick us off with our land acknowledgement. But before I read that off, I've been doing a bit of reflection on what land acknowledgement means to me and my connection to our land and nature. And actually, one of my wonderful colleagues, John, made a comment on Monday that really resonated with me. You know, he went out for a walk. Here in Edmonton, we had a very snowy, stormy day, but on Monday evening, he took the time to go for a walk, walk through the snow, feel it underneath his feet, get the fresh air. And it was a completely different experience and mood for him after that walk. So I think it's important to remember when we're thinking about our land and acknowledging the land we're in, how much the physical nature and land gives back to us. So I encourage you to take as much time as you can out and enjoy this wonderful land that we're able to live and play on together. So with that, I'm just going to transition over here. We acknowledge that the land on which we gather in is the traditional territory of the Treaty 6, 7, and 8 nations of Alberta, and acknowledge Treaty 4 and 10. We acknowledge the ancestral territory of the Cree, the Dene, the Blackfoot, the Stoney Nakoda, the Saulteaux, the Ojibwe, the Tsuut'ina, the 8 Métis settlements, and the homeland of the Métis Nation. We acknowledge that the original signatories of these treaties agreed to its terms so our peoples could create relationship and move forward together in a peaceful way. We acknowledge the land as an act of reconciliation that honors the authentic history of Turtle Island and the original people of this territory. I'm based out of Treaty 6 here in Edmonton, and thank you so much for joining. I'm going to introduce you here to the man of the hour and our speaker today. So Owais Lightwala is a professor, entrepreneur, and optimist. He is currently an assistant professor in the Creative School at Toronto Metropolitan University, where he is teaching and research focus on entrepreneurship, leadership, and innovation in creative industries. He is the co-founder and CEO of Sai, a tech startup that is working to revolutionize the way that creatives manage their money. Prior to that, he spent 8 years as the first managing director for Why Not Theatre, co-leading the establishment of one of Canada's most dynamic new arts organizations and producing industry-changing projects like Riser and the Mahabharata. He is sought after as a bold strategic voice in the culture sector, including from institutions like National Arts Centre, Canada Council for the Arts, and Canadian Heritage. He has served on many nonprofit boards, including TO Live, Mass Culture, Amy Project, and Art Ignite. He was selected for the Invite-Only Impact Program for Arts Leaders, Stanford Graduate School of Business. He has completed the core program, Harvard Business School, was a 2018 Diversity Fellow, Civic Action, a fellow in the 2018 Leaders Lab, Toronto Arts Council BAMP Centre. He is a graduate of York's University Theatre Program and did his MBA at Toronto Metropolitan University. Wow, what a resume. That's really impressive. Thanks for joining us. I'm going to give a quick little, tease as to what we're going to talk about today. So we're going to be diving into the world of our artist-specific tax nuances. And Owais is going to guide us through those 10 big myths for when you're filing your taxes as an artist. So he's going to draw on his extensive experience that I just read out, and he's going to have invaluable insights on effectively managing finance and navigating the complex Canadian tax system. So I'm really looking forward to demystifying some of these tax challenges with you and helping our audience optimize our financial health. Quick note for the audience, if you have any questions throughout, please pop them in the comments. Owais will try to address as many as he can throughout the presentation, and we might have sort of a wrap-up Q&A at the end as well for if we have time for anything we might not have been able to get throughout. After today's presentation, you're going to receive an email from us. It'll take a couple days, but we'll have information on how you can access the recording. We might have some additional materials for you. And of course, we really encourage you to share with friends and family that you think might benefit from Sai and all the information we're about to learn today. So again, thanks so much for being here today, folks. And Owais, I'm going to leave it to you to take it away.
Thank you so much for that very kind introduction, Isabel, and thank you to ATB for hosting this webinar, inviting me to join. I'm speaking to you from Toronto, which is Treaty 13 territory, the traditional homes of the Haudenosaunee, Anishinaabe, Wendat, and Mississaugas of the Credit, along many other First Nations people who have called this land home, and I'm very grateful to now call it my home. And from this location in Toronto, speaking to folks mostly in Alberta, it looks like a lot of Edmonton and around that Calgary, some Calgary folks. I'm excited for this conversation to get bigger and be more national because it's something I'm very passionate about. So tell you a little bit about Sai and myself, so you know kind of who I am and why I'm giving this talk today. Sai is a startup that I've created to help creatives and artists just like yourself to take charge of their money is our mission. And it's something that came out of my own experience of being a theater producer for a long time and now a university professor where I teach thousands of artists, future emerging artists. And a thing that is pretty consistent across all the folks that I've worked with and the folks that I teach is there's a massive amount of fear and anxiety when it comes to all things related to finance. It's probably why I ended up becoming a producer in the first place, was because I was the one person in the room who was the least afraid of dealing with the budget stuff, and found myself gravitating towards that. And I'm very passionate about finding ways to democratize the ability to manage finances and the ability to run businesses, because I really think it's a thing that the arts community can do a lot better to improve its strength, improve its resilience, improve its capacity to succeed. And so with that kind of as my honestly personal mission in life and everything I do, Sai was a venture that we created to try and help in this specific area. And I'll get into a little bit more about Sai at the end of this, because I know you're itching to get to those sweet myths that I've put together for you. I would probably do 100 myth presentation, because I've heard a lot of fascinating things from artists over the years, of misconceptions, of things that people heard from somebody, or they thought that this was the thing, but they don't even know where they got that information. I've tried to summarize the top 10. I also don't know the folks in this webinar. So I apologize if some of these things are like really obvious to you, and some of these things are, things that you already know. I've tried to keep it pretty introduction level, and I will be very, very accessible in terms of trying to make it very clear. I'm not clear though. Please ask me a question at any time in the comments and just ask me to explain something if it wasn't clear the first time around. And then if you want to have like a bigger philosophical conversation, or if you disagree fundamentally with something I said, let's save that for the end of the discussion and we can get into those things later. But for now, I'll invite you to ask me any clarification type of questions as we go. I just find it easier for the way my brain works. So, and if you have the question, probably someone else does as well. I should also mention that Sai is not just me, it's actually a whole bunch of people, particularly my co-founder, Mustafa, who is the kind of technical engineering brains behind the software we're building, and I'm more of the art sector and leadership side of things. So let's jump into our myths. Myth number one that I hear this a lot in a lot of different ways is this idea of being an artist and not actually a business. When it comes to filing taxes, this is one that I think a lot of people are going to get into trouble with if they don't really have a good understanding of what exactly we mean when we say these words business in relation to anything to do with taxes. So the first thing that I want to explain is like, when we're talking about business in this context, we're really not talking about it in the colloquial sense. We're not talking about it in the way that you might think of business as like a profit generating thing. We're talking about business in the idea, in the eyes of CRA. All of this is going to be from the perspective of the Canada Revenue Agency, our tax authority that has a lot of power over, how things are done in this country financially. So if you are a freelancer and you work on a gig basis, you're not permanently employed with any company, or you are permanently employed, but in addition to that, you're also doing gigs. Now, you might feel like you are not particularly powerful, might not think of yourself as a capitalist, but in the eyes of CRA, you're considered a sole proprietor. You're considered a small business. And that small business classification means that your taxes are going to need to be filed like you're a business. So a lot of the logic, if you understand that basic thing, you'll understand why the logic is set up the way it is when we get into other things like expenses and income and profit and things like that. Because for a lot of freelancers, they don't really think in terms of profit and expenses. They just, I do some work, I charge an hourly fee, I get paid for whatever work I do, or I get paid a weekly rate based on whatever the union rates are, or I get paid a flat fee based on industry rates. The idea of thinking of themselves as a business is not always the most logical concept. You don't have to apply that to yourself if it doesn't help you. But one thing that is necessary for you to know is if you are a freelancer, if you call yourself self-employed, any of those things, a worker, you are considered a small business in the eyes of CRA. So why that's going to matter for you is that as a small business, the CRA expects you to report your taxes as a business. The definition of business for them is basically an entity that is intending to make a profit. So the intention to make a profit is important here. And that intention is a legal principle. It's a tax principle. If you're carrying out your activities in such a way that you are intending to make a profit, you're considered to be professional, considered to be a business. This is in opposition to a hobbyist. So there's lots of people, myself included. I have a guitar. I will never be a professional musician. I'm not good enough. I'm not going to ever be good enough. I have all kinds of other strengths, but that is not a place where I'm ever going to make any money. Because of that, my purchase of the guitar, and even if I got guitar lessons or any expenses that I have incurred in the cost of like playing guitar, not businesses, not business expenses. They're not business activity because I'm a hobbyist in that area. That said, there's other things that I am very professional about. My theater production work is very much a professional activity. I went to school for it. I do it for a living. That is something that would be considered business activity from the CRA perspective because I'm intending to make a profit, as in I am doing it for the intention of making a financially lucrative career out of it. Now, again, I know that's very triggering language for folks who are probably not in the arts because of the amazing fame and fortune that you're going to make. You're doing it because it's passion for you. But we need to understand this framing so that we understand kind of how CRA is going to look at us and how they're going to treat us when we're doing our tax filing. Now, there's also benefit to this business framing, which is tax deductions. When I'm a hobbyist, any expenses that I incur, that's my problem. I'm just spending money, like all the things I spend money on. It's not really their concern. But as a business can deduct legitimate business expenses from their tax filing, right? They don't want to be able to, they don't want you to have to pay taxes on everything you earned, regardless of what you made. If you were a lemonade stand operator and you sold a lot of lemonade, but the entire revenue that you generate from selling lemonade, you used to pay for lemons, you have nothing left over. There's nothing to pay taxes with. So the CRA understands that for businesses, you got to pay for lemons. And then what's left over, that's your profit. That's the actual part that they're taxing. This is the concept of business expenses and the concept of write-offs and the concept of deducting your business expenses from your income so that you have the profit left over. That's actually what they're trying to tax. So being seen as a business is actually helpful to you because you can actually now deduct some certain kinds of expenses in a way that will help you reduce your tax liability. And your net income is the thing that they're going to be looking at. Just on a practical note, in this area, one thing that can help you if you are confused about this stuff or new to it, some of you have already done this probably, is you might want to consider separating your bank accounts. You might want to have a business account and a personal banking account where you manage your business activity separately from your personal activity. So all the purchases I'm making that are related to my work, all the income I'm generating related to my work, if I have all that in a separate account, it's just so much easier to look at a statement at the end of the month or the year and go, oh, that's what's happening. That's what the business activity is. And when you combine business and personal, especially for self-employed folks, and I have been a self-employed person for a lot of time, so I really find this challenging to going through my expenses and figuring out, wait a minute, was that thing a business thing or was that for personal reasons. I can't remember now because a lot of things will be blurry. Sometimes I have a business meeting in the same cafe where I also like to just go get a tea. So not always clear to me. But if I have separate bank accounts, it's very easy because I remember why I use that card versus the other card. So that's myth number one, busted. You are indeed a business, at least in the eyes of the CRA. Let's see, there's some questions coming in. If they take you seriously, you should take yourself seriously. Agreed. Good advice. Thank you, Tammy. Is there a threshold where it makes sense to financially incorporate? Let's come back to that. Can you remind me at the end, Sedna, to talk about incorporations? I have not covered that in one of the myths, but it is a whole thing I have lots of opinions about. So I'll come back to that, but it's a great question. And let's talk about, well, actually, on that one, what I will say is just because CRA sees you as a business does not make you a legal incorporation. That is a whole other concept, as Sedna is identifying. Being a corporation is a separate legal entity. You are just a small business sole proprietor automatically if you have any kind of self-employed income. So thank you for that question. Helps me clarify. Number two, I'm too small to be audited. This is another thing that I've heard from lots of people about. I think it's a bit of a thing that people really want to believe that because artists are generally, the average artist in Canada makes like $30,000 a year or something, that they're not financially lucrative enough to be a kind of major area of focus. Unfortunately, that's not really how the CRA is set up. They are set up in a kind of agnostic sense in that they don't go, oh, we like artists and we don't like bankers. They kind of are pretty generous in terms of what they're looking at. They're looking at everybody. They're looking at everything. They're not actually interested in kind of what your size is or what your category is. In fact, if anything, one thing that I have heard from a lot of folks who work inside CRA and accountants is sometimes smaller businesses and individuals who are on the lower end of the spectrum, they often make more mistakes in their tax filing because they have less professional help available to them, or they can't afford to have as good bookkeeping services. And there's actually more things that CRA can find. And when CRA comes looking, they are going to find something. They're always looking to, find a way to finance the CRA operation. So the investigations from CRA are likely going to find some discrepancy there. So being small is not, unfortunately, a defense from the CRA. They use all kinds of systems like algorithms where they will look at your ratio of expenses in relation to your revenues. They will flag things just based on, industry norms, based on other people like you. And that can be enough to trigger a review or to trigger an audit. There's no necessary reason why they can or can't look at you. So being small is not something that is automatically a good thing for you. And I know lots of people who have been very, very severely financially penalized because they didn't know what the right thing was. They weren't filing correctly, or they didn't do some very necessary reporting obligations. And even the person calling from CRA was like, I'm really sorry to destroy your mom and pop grocery shop, but that's the rules. Like, this is what the law is. I can't not enforce this. So this is one thing that I would like to bust for everyone is like, it doesn't matter how small you are. You definitely want to make sure that your house is in order when it comes to your taxes. Okay, let's get into a little bit more of the specifics of, what kinds of tax things that I hear people throw around that are maybe not the most helpful advice. I heard this recently, and I think it's really funny, where someone thought that they can write off all of their fast food takeout because they're doing it while they're working. And this one is tricky because there is actually absolutely a legitimate business expense for meals and entertainment. There's a few things you want to remember about meals and entertainment. Number one is that you can only claim 50% of the meals and entertainment that are eligible. And the eligibility is basically whatever is reasonable and in service of direct business activity. Now, you might go, and I know lots of people who say things like this or legitimately believe this. I'm working 12 hours on a show and we're in tech week and it's like a crazy time and there's definitely no way for me to go make a lunch. So I had to buy a meal. That's in service of the business work that I'm doing. That's totally a business expense. And CRA would disagree with you. They would go, how is that any different from a nurse at a hospital buying their lunch in between their shifts? So when they say business expenses for meals and entertainment, they mean, are you doing a networking meeting with a client? Are you doing a networking meeting with a collaborator? Are you having a coffee with someone to just kind of keep on top of industry stuff? Are you having an event where you're hosting people for some purpose related to your work and there's food and expenses there? And the 50% thing, I don't know this for sure exactly if this is true, but my theory is the reason for that is if you're having a one-on-one networking meeting, you're going to eat half of the food and they're going to eat half the food, and your part of the expense is not business. You needed to eat to survive anyways. And the other side, though, if you're paying for that, then that's something that you are incurring as the cost of your business. So this is one thing that like we want to be very careful of, because meals and entertainment is something that my accountant is constantly warning me is an area that lots of people get into lots of trouble. It's rife with all kinds of misunderstandings and abuse, and CRA loves that category because they always find something that people did wrong there. So basic rule, only 50% of total meals entertainment is even eligible. And even within that, if you had a meal by yourself, it doesn't count unless you're traveling, unless you're overnight traveling, because then again, the expectation is that there's no way for you to have been able to eat the way you would have at home, right? So that's a different, yes, thank you for asking, Rachel. When you're traveling for work, it is eligible. When you're receiving per diems, that's tricky because depending on who you're receiving the per diems from. So if you're receiving per diems from a company that's hiring you, that per diem is basically cash in exchange for you to spend on meals. So neither does the per diem get recorded by you as an income, nor does the expenses you then incurred get recorded as expenses because you didn't pay for them. Your employer paid for them, if that makes sense. So the per diem is basically your employer paying for your meal, if that makes sense. It's the same thing as like if I, took out my employee for lunch and I paid with my credit card. It's the same thing. It's basically the per diem is the version of that, where your employer is saying, here's an allowance for you to go have the meals. They're the ones who can claim that as an expense on their behalf. You cannot then say, I also claim those business expenses. That's double dipping, right? Because it's not your money that you paid with. Anything else about that that's coming in? No, great. Traveling for work, a grocery bill is eligible. This is a tricky one. Yes, technically, if it's reasonable. And also, depending on which accountant you talk to, you might get different answers to that. This is getting into now gray area where I will stop myself from pretending to be an accountant and say there is a possibility, and also people will scrutinize it because it's a slippery slope, right? And you can understand why it's a slippery slope, because groceries are absolutely a thing that like people buy as part of their life. So think from the perspective of CRA, if you were like investigating this case yourself, would you look at this and go, interesting that you spent $1,000 on Costco while you were doing a 2-day weekend trip in Niagara? That seems quite sketchy. If that's what it is, then it's probably not going to fly. So the problem with almost all of these rules is the answer is generally it depends. And there are some things that are very clear rules, but a lot of the things are context specific, as we're already discovering. Thank you for those questions. In terms of how to protect yourself from these things, a few things to make sure that you're doing so that you are in the best position possible. Make sure that you're keeping every single receipt for every single meal that you ever have, every single entertainment expense you ever have. You do not, there'll be no good will come of not having receipts and not having documentation. The other thing, I don't know if you're like me, I live my life by my Google Calendar. I don't even know where I'm going to be after this because I don't know what's in my calendar next. So if you use your calendar, get in the habit of keeping detailed notes. Who did I meet with? What was the meeting about? As long as you have documentation so you can back it up. If they come asking, they say, show us these random things that you claimed. We'd like to see some evidence for why they were business things. And you can say, well, here's the calendar entry this is the person I met. I have an email thread setting up the meeting. I have the receipt from the place that I made that expense, and it shows you that there was like multiple things purchased for more than one person, etc. So documentation is always going to be your friend, and keeping as much of it on hand as possible will help you protect you from that. Using the reasonableness test is also helpful. If you have expenses that look unreasonable, they will probably be perceived as unreasonable. You do not need to keep paper receipts specifically. Digital receipts will absolutely count if you have those as well. The main thing is just you need to have something that looks legitimate, and you need to keep those for more than 7 years. Following on the question, credit card statement. Good question. I used to actually, this is a myth that I busted for myself recently, not recently, a few years ago, but I thought credit card statements counted as receipts. They do not. Receipts are receipts, and credit card statements will help. They will not hurt your case to have additional evidence. But they're pretty skeptical of credit card statements. There's a whole reason for why, basically, and it has to do with like how credit cards, can be manipulated, and you can make an expense and then get a refund later, and etc. So receipts as evidence. Like in my university, just fun fact, when I have to reimburse the travel expense, not only do I have to show them the like invoice for the flight I purchased, I have to show them the boarding pass to make sure that I got on the plane, because you can buy a refundable flight. So the same level of suspicion is true of all bureaucracies everywhere, I guess, that they just don't trust people to do the right thing. And fair enough, given the state of the world. Okay, let's keep moving. Myth number 4. I work from home, so I should be able to claim all of that as a business expense. This is a fun one. It is absolutely the case that you can claim some kind of work from home expenses, probably something that everybody is doing in some capacity, more and more these days. And it's also true that like most people have a very inflated sense of how much you can actually claim when it comes to this as an expense. The way CRA understands this is like a little bit old school, where they literally are like what's the size of your desk? Like how big is the workspace in your ideally, if you have a room and you say that room is my office, that's probably the best way you can maximize your claim, because you can show a room as an office. But if you have like, if you're like me and sometimes you work on the couch and sometimes the kitchen table and sometimes in your bed with your laptop, you don't get to count that whole area as your workspace. You basically have to say, what's a reasonable percentage of my home office that I can actually claim? There are some benchmarks for this that you could look up, or you can talk to an accountant about. It also depends context on what you do. And Uber driver has very little reasonable claim for why they have work from home expenses. But a painter might have pretty reasonable claim to make that like 30% of their apartment is a studio. So it depends on what you do and what you're actually, I have studio, so they're in my work. That would be office claim, yes. Is this separate from your accommodations? Is this part of your home accommodation? You definitely cannot use the whole area in your house as a space needed to prep, Krista, even though I wish that that were the case, but they will absolutely flag that. The other way to think about it is you might think about it not as like square footage, though that is one way they calculate it, but you might also think about it as like, what's the percentage that the space gets used for that purpose, right? Unless you're dancing 24 hours a day, 7 days a week, 365 a year, you're probably doing your dance rehearsals for a percentage of time. So if you imagine that and then take the square footage, in no circumstance are you going to be able to say that the home that I live in is also a place where I spend a majority of my time, and the majority of that house is used for work, if that makes sense. And I'll stop myself there because I'm feeling myself wanting to give you more exact numbers, and I don't want to do anybody's taxes on this webinar. That will get both of us in trouble. So the thing to look for here is like you don't want to be a position where you are being aggressive as perceived by CRA, but you also want to be reasonable and make sure that you do calculate whatever you are actually using. And again, documentation is key. If you can't really prove thing in paper, because all the correspondence CRA is going to be paper, then it's going to be much harder for you to justify that, right? So someone said a converted garage, probably going to be a lot easier to prove that because you'll be able to show pictures of that space and it'll be much clearer to them when they look at it. Is this a workspace or not? Again, if that converted garage has a car in it, you understand the problem, I assume. Great. Anything else I want to say about that? There's also some expenses in terms of your home office that you can deduct. Won't need to get into detail of those, but that's something for you to look at as well, of like reasonable costs that you incurred as part of your home setup. Let's talk about HST. True story. I did a budgeting workshop a couple of years ago. It was one of the reasons why I founded Sai, was this actual thing that happened to me where I was teaching budgeting to emerging artists, and I started talking about HST and why they need to track it. And someone started crying, and I stopped the workshop. I was like, "What happened? Are you okay?" And they said, "I've just never heard of HST. I don't know what you're talking about. I'm really overwhelmed. This is terrifying. Am I going to jail?" And I felt really bad for them, and I was like, "There's got to be a better way to do this. I don't know why this stuff is so scary for folks." So let's tell you 2 things about HST that you need to know. One is that you do need an HST number if you're making more than $30,000 annually as your gross income. So by gross, I mean just what comes in the door. Never mind what your expenses are. Just if you're bringing in more than $30K from self-employment income. So let's say I have a professor job and I make money there. That doesn't count, right? It's whatever I generate from self-employment income. if I make more than 30,000, absolutely need a HST registration, and you need to start doing all the things, collecting HST, remitting HST. Probably a lot of people know this. I'm sure if I did a show of hands, which I can't because it's not Zoom, unfortunately. But if you did do a, you probably know this. You probably know the 30K number. The thing you might not know, and this is why this is a myth, is you can get it before that. And it's actually sometimes beneficial to get it sooner than when you've made 30K a year. And the reason for that is because what the HST number allows you to do basically, and yes, exactly. Thank you, Ron. This absolutely applies to GST as well with the provincial differences in provincial sales tax, but GST, HST, all I'm talking about is sales tax registration here. You are correct. It absolutely is called GST in Alberta. This is one of my Torontoisms. I apologize for my Toronto-centric worldview. So let's clarify. GST is federal sales tax. HST means harmonized sales tax. PST means provincial sales tax. In most provinces, they've now moved towards HST, where the GST and PSTs combine. Because Alberta, you guys don't have a provincial sales tax, you just have the GST, which is the federal component. But this exact same, everything I'm saying still applies, and I should update this slide to say HST/GST, and that will still be true. So the thing that I want to say about why you might want to get a GST or HST number before you hit 30K in revenue is for a lot of artists, they get a lot of income from grants. So, most of my career has been funded from funding that I've received from Canada Council for the Arts, Ontario Arts Council, Toronto Arts Council. You guys have your own equivalents in Edmonton Arts Council, Alberta Foundation for the Arts, etc. And if you receive grants from those sources, those grants don't include HST in them. The way that they pay out is it's called a grant. So they're giving you a sum of money to do a project. Now that is considered income for your income taxes. That's considered business income. Again, just because you are an artist and doing artistic things doesn't mean CRA doesn't understand you as a business. But because you're not getting HST on that, and you might be under $30,000 a year, you might go, what do I need HST for? You're still paying HST or GST. So every time you make a purchase at a store or for goods or service, you're still going to pay, if someone is registered, you're going to have to pay that sales tax. And when you are registered for a sales tax number, you can then claim the amount that you've paid as a rebate. And if you are not registered, then that money is gone. So to give you a bit of a concrete example, let's say I got a $10,000 grant from Canada Council for the Arts, and I'm not registered. It means that the purchases that I can make have to include sales tax and then come to a total of $10,000. That's the amount of money my grant has for my project, right? But if I am registered, then I can spend $10,000 plus sales tax, because the sales tax component I'm going to get a rebate on at the end of the year when I file my filing. The reason why this is a very unique situation for artists, for most businesses, you will also, if you register for sales tax, you will also be charging sales tax to your clients. If you're selling your goods, if you're selling your services, if someone is buying your artwork, someone's hiring you to work, you're going to be collecting sales tax. So generally, the idea is, sales tax in, sales tax out. What did you collect? What did you pay? But if you're getting grant income or foundation income, there won't be sales tax coming into you. So you will actually be spending more than you're getting. And this is a place where being under 30K you might still want to consider registering. And there's more resources that you can look up about how to do that. But it's something to think about if you are in the situation where, you're not in the plus 30K, but you are receiving primarily grant-based income. Okay, myth number 6, T4As. I hear so much anxiety about T4As all the time, and I, making these slides, I called up my tax expert and was just like, just want to make double sure, super triple sure that I understand this correctly. And the T4A thing is full of lots of confusion. A T4A is a slip that you would get as a contractor if you are, sorry, just let me pause and answer Mark's question. Yes, if you have registered for a GST number, you have to charge GST to clients. You cannot not do that anymore. So once you've registered, then there's no going back. You have to keep doing that. So thank you for asking that. I'll get to grant income in a second, Rachel. And T4A slips are basically a slip that you get like a T4, which is a slip that you get from your employer. Probably you're familiar with this one, where you work a job and you send your T4, say, this is how much money you made from us, this is how much income tax we deducted, CPP we deducted, EI we deducted. The T4A is a very similar thing that just says, you worked for us, this is how much we paid you. Now, the actual rules around when you have to issue T4A are very gray and muddy and not super tightly enforced, with the exception of construction. And construction, which I don't think anybody in this call is probably construction industry, it's super religious. Like they have to do every single time they pay someone, they have to issue T4A. In every other industry, sometimes you'll get them, sometimes you won't. There's a threshold of $500. If it's below that, it's considered optional and you don't have to do it. If it's more than that, then you're supposed to do it. And that's when you really should be getting the T4A. That said, the reason I'm stressing this as a myth that you shouldn't be confused about is like, if you don't get a T4A, let's say you were a contractor, you work for somebody, you made $1,000 last year from this company, and they didn't send you T4A. You don't get to then say, well, I guess I didn't get paid from you last year. I'm not going to claim that on my taxes. You are still responsible for claiming your income on your taxes, whether or not the company did the right job and filed their paperwork correctly. Your T4A is just a record of that payment happening, and it keeps things clean and consistent. But if that doesn't happen for any reason, you are still responsible, and CRA can still come and say, hey, wait a minute, why did these people pay you that money? And you go, oh, I did some work for them. And they go, aha, income. Congratulations, we are now taking away all your money. So you are still responsible for keeping track of all of your income. And I personally don't rely on T4As coming in. I like let them come in and I put them in a folder. But if they don't come in, I don't care. I keep my own records of what work I've done for who I've done, and then make sure that I keep track of that self-employed income. Because there's a lot of arts organizations that are, I'm sure you know these folks, they're very, very scrappy. They have very small administrative teams. They're not always on top of T4As. They're not always able to do that work correctly. And so you don't want to rely on them to do that very important work because you're the one who's going to be responsible. In terms of what counts as a contractor and whether it be a sole proprietor, so if you hire an individual at all that is not an employee, they are a subcontractor basically. Anybody who you're hiring is now considered a subcontractor. The sole proprietor registered thing is an interesting question because I think you mean registering for a small business number or with a business license. You don't need to register anything to be a sole proprietor. As soon as somebody gives me money that is not my employer to do anything, I am now a sole proprietor in the eyes of CRA. You don't actually need to like fill out a form or anything. You're automatically become a sole proprietor. So an individual and a sole proprietor are kind of the same thing in that context. Registration, there's a couple of different things that could mean. You could be registering as a small business, you could get a business license, or you could be incorporating. I'm not exactly sure what you mean by that, but the default assumption you should be working with is that you are a sole proprietor already. If you have ever accepted any income for any work you've done, that is not that's not on a T4 slip, because that would be employment income, and everything else is considered self-employment income. Does that make sense? Anything else I want to say about T4A? No, that's it. Don't worry if you don't get one, but keep on top of your income tracking. Number 7, someone was asking about grants. Let's talk a bit more about grants. So grants, what's the deal with them? I just said that like you don't get any sales tax on grants, so clearly they're tax exempt, right? Unfortunately, that's not the case. The CRA understands grants to very much be taxable income, and the way that they're taxable income is very specific. So this is going to go into what is called business income in your tax return, and just like all the income for your business. So whether I made a painting, sold that painting, got some money, whether I got hired to be a dancer in somebody's show and they paid me to do that, whether I got hired to deliver a workshop that got paid a fee, or I got a grant from Canada Council to do all those same 3 things. It's just income. That's all you need to know. Grants are basically almost always income, with one exception, which I'll get to. With that grant income, what you can do is you can deduct your business expenses. So Canada Council, I'm producing a theater production. It's going to be an awesome play. I'm doing a new version of Hamlet where Hamlet is going to be Bugs Bunny. It's going to be awesome. And I got a $60,000 grant from them. That's $60,000 of income I just got. But producing a play, especially Hamlet with Bugs Bunny in it, is going to be very expensive. Never mind rights issues I'm going to have trying to get the licensing from Disney or whoever owns Bugs Bunny, Warner Brothers. I'm going to spend $55,000 to produce this show, and $5,000 is going to be my fee as the lead producer and director and artist and whatnot. And I'd be lucky if I even make that much, right? For those of you who've ever produced a show, you know what I'm talking about. So the only actual net income that I have, right, from the gross income, the revenue, and then the business expenses, that $5,000. So the amount that I'm paying taxes on is that gap, that net income. That's the profit. And again, for CRA, that's profit. For Canada Council, that's your fee as an artist. But in the same way that if I made money from any other source, if I worked a job, I'd have to pay income tax. you just consider this you working for yourself, you're paying yourself, and therefore you're paying tax on it. So for the most part, grants are business income and they're absolutely taxable. And this can get into some tricky territory if folks are getting the grant and the majority of that grant is their income. That's to them, and they don't think of it as that, then that can be a problem for them and their taxes. So you want to treat it like it's income for you, and it's going to be taxed whatever is left over after you pay for expenses. And the exception to this is educational grants. So scholarships, bursaries, grants inside an educational institution context, if you're a student, those are treated very differently. I'm more speaking here about professional artists getting Arts Council grants or foundation grants. Those should be considered business income for you, or I would rather you consider them that by default rather than the opposite. And it's always easier to overestimate what your tax liability might be. That way you'll only have pleasant surprises rather than underestimate them and then find you owe $10,000 that you don't have right now. Sponsorship received, same as, sponsorship is just income. If you get sponsorship, that is absolutely a source of business income. You are providing a good or service in return for that money. So absolutely, it would be taxed exactly the same way. With grants for individuals versus groups, same thing. There's not really such a thing as a grant for groups. If you look at the fine print, they give you a grant for a group, but one person is the lead contact. That person has to file it under their taxes and they pay the rest of the group. So the rest of the group is getting paid by that person, but somebody is going to be the lead applicant or the lead recipient. You don't, most arts councils can't give a grant to an unincorporated collective. So there will be somebody who's still liable for that and they're responsible for that on their tax situation. Awesome. We're doing great. Let's move on to number 8, gifts. This one is, I wanted to phrase it differently, but I'll be more charitable to the person who brought this up, because, there's some philosophical questions here that you might have. The thing you need to understand about gifts that I want to make sure that we are on the same page about is if you receive something that is not cash, but has value and has market value, you might be like, oh, I'm so clever. I have avoided a tax liability because I didn't get paid any money. But the CRA will not agree with you, right? The CRA is onto you. They're smart enough to understand that a gift that has monetary value is income. So if you do a barter thing where someone asks you to do a job for them, and then in return you got free rehearsal space in their studio, technically the job that you did for them, they should be counting that as income, and the space you got from them you should be counting as a contribution to you. And this stuff needs to be counted at fair market value. Fair market value is a concept that every tax authority is obsessed with. It's how they figure out, what would this have been worth if you were going to pay for it? Sometimes that's very easy to figure out because the rates are publicly available for a rental of that studio, or it's very hard to figure out because it's a painting, and now you need an appraiser to figure out what this painting would be worth in the art market, or it's something nebulous in quality, such as I did some design work. Different rates for graphic designers, depending on who you are. Again, look for the reasonableness and look for the kind of ability to make sure this is done in a way that is a way that would be justifiable to a CRA bureaucrat who doesn't understand anything about your artwork or your practice or your industry. And if a gift is given to you with no expectation of return, then that's different. If you receive a personal gift from someone where there's no transaction happening, then that would not be something that you would need to report as income. But if you are getting a gift in exchange for something you're doing for them, technically that is income. Now, I will be the first to admit that I did not know this for a very long time. I did all kinds of bartering things in my career that I never even knew how to record those. It's hard to track these things. It's hard to get on top of them. But if you are relying on this as a big percentage of your work, and the value of those things would be significant dollars, I would highly recommend that you take a look at it. I just don't want you to think that you are safe and then don't like unpleasant surprises. Let's see, there's some questions coming in. Loans are not income. Loans are loans. A loan is something that you need to repay, and they understand that is not an income for you. Depends on who's giving you the loan, what's the loan for. The kind of full detailed answer about how you would deal with loans is something that I won't get into. I'm going to save that for an accountant, but they would not be considered generally speaking. In terms of donating your service to local charities and your time, you pay out of business subcontractor work, they can be claimed. So donating to charities is a little different from getting a gift as an independent business. Charities are a completely different. We need a whole other webinar for charity law and the way that charity tax regulation works. You are correct, sort of, that the donations can be because they're not tangible, but that's also not entirely true. There's absolutely things that are intangible that do get valued for charity donations. The trick with those is like, it's almost worth the hassle, which is why they generally just say don't bother doing it, because the amount of work you have to do in charity donations, because think about what charity donations could be used for, right? If I was a gazillionaire and I was like, oh, how do I not pay taxes? I'm just going to donate a lot of money to charity, or donate a lot of stuff, in-kind expertise to charity. I value my own expertise at $1 million a minute, and I get to write that off. Like, that's where it gets tricky. And so there's a whole bunch of charity rules around why that's set up that way. But you don't need to kind of worry about that, I think, for the purposes of a self-employed person. If you give a gift, I'm an actor, I give my audition gift cards, a thank you. I would say thank you gift cards are less of a quid pro quo. They're not doing it in return for those things. I hope that's not why people are auditioning, just to get the gift cards. Again, not an accountant, and I'm definitely not your accountant. So that to me is something that we're now getting into, like, it's both very, very small and very, very great. So I would be interested to hear a professional opinion on that. Work for a music school, teach a lesson for the students, build for the schools. School collects the money, pays me, should I because just in school, insurance contract with the school. So if you were a contractor for the school is just hiring you to do a service. If you make more than $30,000 a year, absolutely you should be collecting GST. If you are making less than that, you may want to, you may not want to. That depends on your expenses and your income. If you don't have a lot of expenses and there's not much for you to do by collecting sales tax and it's less than 30K, you might not want to bother with the trouble. But the school, like, the students are irrelevant in this. You're not even in any financial transaction with them. You're in a transaction with the school. They're your client and they're just paying you, right? Great questions, by the way. Thank you so much. This is really helpful because, I don't know all of you folks. So when you actually ask me real life questions, it just makes me think of even more things that I can help clarify, and I get a better sense of who's in the virtual room. Number 9, the deadline to file. This is a fun one. We had took a long time in our team to wrap our heads around this one. The deadline to file is June 15th, actually. That is true for self-employed folks. The regular deadline for everybody else is earlier in April. And you go, great, CRA is so generous. They understand being self-employed is hard. I have to do more work, figure out my taxes. So they gave me this extension, except they didn't give you an extension on your payments are due. This is completely backwards. If I ever become Prime Minister of Canada, I'll fix it. But it makes no sense to me that April 30th is the deadline for paying your taxes, even for self-employed people. June 15th is the tax filing deadline, not the payment deadline. So if I owed money, as of April 30th, they're going to start charging the interest. Now, they won't even know how much I owe or what interest to charge until I file. But as soon as I file, if I owe them money, they'll say, you owe us interest plus what you owe us since April 30th. So my recommendation for most people is that you should probably just aim to file your taxes by April 30th so that you at least know exactly what you owe. Some of you have a system for this and you already do prepayments or you do installment payments over the year. If you're doing that, awesome, good for you. But for most people, I think it's probably just easier to do it in one fell swoop, get it over with, and then you don't have to worry about it anymore. Why you would want to extend your tax season to be even longer and even more miserable is a mystery to me. But the main thing that I want to impress upon you is that they will absolutely not be kind about the fact that you didn't understand the deadline. Again, ignorance is not a legal defense. And so this is one that I want to make sure that any self-employed artist is under no illusions of what the actual deadline is for when you owe the money, which to me is frankly the only deadline that matters, is when do I start being charged interest. Okay, that is our whirlwind of myths. The last one is that all this is very hard. If I'm being honest, this one is not a myth. It is a little bit complicated. It can be very hard. There's a lot of edge cases. There's a lot of context questions. There's a lot of expertise that's required. As you heard me saying, even, like, I very quickly reached the limits of my expertise because I'm not an accountant, but I have learned a lot from working with tax experts and accountants. And as I'm building a company to deal with finances, I have picked up a lot of knowledge that I've tried to summarize here. But even I make sure that I run everything by our tax expert, I run everything by accounting professionals. And then when we actually get into, things that there's no clear answer for, that I'm not relying just on my own intuition about things, because things that, as I just showed you, myth number 9, things that make sense to me don't necessarily make sense to CRA. That said, a little tiny infomercial that I'll squeeze in here for Sai is this is exactly why I built Sai. The reason for all this is that was 10 examples of a bunch of stuff that people often get wrong, and it costs them lots of money. And the thing that drives me crazy is that the folks that it's costing a lot of money are folks who don't have much money to spare. The artists and creatives in this sector cannot afford to lose any more money from the little that they have. And the idea that we would be giving it up in penalties, in late filing payments, in interest payments is really heartbreaking to me. So the vision with Sai basically is, can we automate some of this? Can we build in that context into a software that knows all of the stuff that I've talked about and a lot more than what I just said, that figures out things like, okay, meals, entertainment, it should probably be this much and this threshold, otherwise you're going to get in trouble. Also, it can compare not just your tax filing, but other people's calculations and see what the industry norms are and get more intelligent. And basically our goal is, can we get to a future where no artist is ever getting audited again because their taxes are so clean and so well done, and they don't have to do much of the heavy lifting. Frankly, the software does it all for you. So that's our vision for what we're building. If it sounds like something you are interested in, there's a QR code, there's a website. You can go on there, find out more about what we're going to be releasing in a few weeks to the public for this season, to help them file their 2023 taxes. Also, I'm sure this will be sent out in an email. And if you have any questions about our offering, you can go to our website and reach out to our team, and we'd be happy to chat with you more about all of the things. And if it's something that we can't answer, we have tax experts. Don't worry, I would not try to build this on my own without someone who knows everything. That's all the things I wanted to say. Oh, we were going to do some parking lot questions. Do I have time, Isabel? Am I doing okay?
You have lots of time. Yeah, absolutely. I know we had that sole
Brilliant.
proprietor versus incorporated. I don't know if there's anything extra you want to add there. We've been putting some great resources in the chat around that one.
Yeah, I haven't kept up with all of it, but I've been seeing the chat is live. It's lit. So here's my opinion about incorporation. It used to be the case in Canada that for a long time, incorporation was something that was completely different reality from a tax perspective for people. And that's why every plumber and every small contractor has a corporation. Because there was a time where there was a completely different tax reality. Over time, the government figured it out and they started closing all the loopholes. So that gap in terms of what the immediate tax implications are have narrowed a lot. What it means to incorporate is basically you create another legal entity. That legal entity is now assuming the liability. It has its own name. It has its own registration number. It can hire people. It can have employees. It can have owners. You would probably be one of the owners who has shares in that corporation. For most of you folks, you'd be talking about a private corporation as opposed to a public corporation. Public not in the sense that it's owned by the people. Public in the sense that it has shares on the stock market. So Google is a public company because I can buy, in fact, I do own one share of Google, half a share or something. Now, a private corporation is something that's owned by you or whoever else the directors and shareholders are. And as a separate legal entity, one of the big benefits is if you make more money than you can possibly spend in a year, there are some long-term tax implications that corporation helps you with. So as a general rule of thumb, what I tell artists who come to me about incorporation is if you are managing projects and grants and income that is more than $100,000 a year, you should talk to an accountant about incorporating, because yes, there's additional paperwork, but what happens when you're not incorporated, and this actually happened to me, is I got a big grant one year. I got that grant, and in that same year, I had to spend that grant on expenses for my business, because if I don't, I have to pay income tax on it. But the expenses for that project were going to continue to the next year. As an individual, I just take that money and say, oh, don't worry, guys, I'm going to spend it next year. CRA doesn't understand that. They go, what were your income for this year? Your expenses for this year. And so I was in a weird situation where, because I had this huge project grant, but the project wasn't finished, I couldn't just carry forward the money. Incorporation, you can do that. You can carry it forward. So when the money gets larger, even if you are not making that much, just the scale of what you're managing is bigger than 100K, you should absolutely look into incorporation. The liability stuff there's some benefits, but honestly, at the scale we're talking about, it's not the primary reason. The primary reason is how you can manage your cash flow, how you can manage tax kind of implications for your personal finances. And if you're doing anything with any kind of legitimacy and scale, that's the other thing that like it'll help you with, where you can get a separate registration, bank account. If this is something that you're going to hire employees out of, the corporation can be their employer. If that corporation goes bankrupt, it's a limited liability. It's not the same as you going bankrupt. Again, not an accountant, not a lawyer, but this is my opinion about incorporation based on working with hundreds of artists. I've incorporated many companies. I've run several nonprofits. I've done my own charity incorporation. And my experience with those is like a nonprofit incorporation or a for-profit incorporation can be advantageous, especially if you're managing income that is like large project grants or large project commitments, and you want to do it over multiple years, and you can't spend all the money in here because you don't have that kind of work. So that's my kind of short opinion answer for the question about that. Do I have any checklists or spreadsheets help them organize getting everything in order? Every accountant seems to have their own version of how they do this. At Sai, what we're building right now is the opposite approach. One of our rules internally is that there's no spreadsheets allowed, at least from the perspective of our users. I feel like spreadsheets are like a very archaic kind of way of organizing things. So we're trying to take a very different approach to doing this, where Sai will help you organize all of your business expenses and your income and figure out what categories to go into and figure out what the thresholds are and figure all that out for you and show you on the user end the things you care about. How much money did I make? What's my tax bill going to be? How much expenses do I have? How much do I have left over? That's all that I, as a person who manages my own money, care about. I don't really want to see. There are people who are really like into spreadsheets, and those people are going to be fine. I'm not worried about those folks. But for the folks who are like, I don't really want to do that, we're trying to avoid building that. I don't really have a favorite. Frankly, if there was a system out there that was really great that I would recommend off the shelf, I wouldn't have had to build Sai. Good question about whether to replace QuickBooks. Today, it doesn't replace QuickBooks. It works really well as an alternative for a very specific person, a self-employed artist and creative. Eventually, our vision is that it could replace something like QuickBooks or Wave Accounting. So those are accounting softwares. They do bookkeeping primarily, and their purpose is for you to keep track of your accounting. They do it very badly in a way that's very cumbersome and very painful. For those of you who've done any bookkeeping, not fun. We're trying to automate all that in the future. We're starting with just the tax filing feature. If you work with QuickBooks already, it wouldn't be particularly helpful for Sai. And if you didn't, it wouldn't make any difference for Sai. So Sai is designed from the ground up for people who have no system. And eventually we won't need a QuickBooks. You won't need an additional accounting software. We will be that. We will also be your tax filing system. We will also be your kind of personalized advisor. We will do a whole bunch of things that hopefully will make lives easier for artists, budgeting, things like that folks are currently doing in a lot of different, scattered in a lot of different places. So the output from Sai is not input into tax filing. We do your tax filing for you. So we're working with a tax filing company, and we actually do the tax filing on your behalf. Our tax filing expert takes on the liability. You sign an engagement letter with us just like you would if you went to an accountant. The difference is it's significantly faster and easier than going to an accountant. I don't know if anybody's tried to get an appointment with an accountant in tax season, and how they treat you when they're like so overwhelmed and have so many people coming in the door. And frankly, artists are the least financially lucrative client for them. Like, they have lots of much bigger ticket people coming in the door, businesses, corporations, who also want their taxes and their, and year-end stuff done. So it's not always a great experience to go to a retail account, my opinion. Eventually integrate invoicing. Yes, one day we would like to do invoicing. We'd like to help you integrate payments. We'd like to make it so that you could do everything in one place. We're not there yet. We have to do one thing at a time. Yes, if you have a spouse and accountant, you can do it solo as long as you're filing your taxes solo. We're not set up for filing with a dependent in our first year. So that, unfortunately, is the limitation that we have right now. Along with, we are not able to do taxes for people in Quebec. But we do your sales tax calculations and your income tax filing for self-employed folks in the rest of the country as of this year.
Amazing. Well, I learned a lot. Look at how much you covered in 55 minutes. Thank you so much, Owais. That was incredible. I really appreciate your time. And I don't know if you want to. Rachel's thrown in one last question there. Maybe we can
We're
tackle
not
that.
set up. We're not set up for partnerships either.
Okay.
We're set up for solo people right now. But sign up for our wait list. It's really a question of like how quickly we can raise more resources and get the. I don't know if anybody's tried to build software lately, but it's very, very expensive and difficult. We're trying to do this in a way that is very accessible and thoughtful for the arts community. So I want to get it right. I don't want to, overpromise too much too soon. But if you are a solo person trying to do your self-employed taxes this year, please check us out.
Great. Well, we'll end it there with the questions. But again, thank you so much. Invaluable session. Really, really appreciate your time. I hope we can do more. For all of you, you might have seen my colleague Paige posted a survey link. It's kind of pinned at the top of the comments there. We would really love if you could take a moment to give us some feedback so we can, do better or do worse. Who knows? But we also would love ideas. If there are other things you'd love to learn about that we can help do future webinars in the future, let me know. So take a minute with that survey. I'll just quickly highlight a couple webinars we do have coming up. We'd love to see you there if there's any interest. So on March 6th, we have a workshop focused on how to run a cost-effective business. Operation Optimization Secrets. That's going to be live in Edmonton. So for those of you that are here in YEG with me, on March 7th, we're going to be doing a webinar focused on the financial wake-up call for founders. So that sounds really interesting. And on March 12th, we have a workshop focused on you're hiring your first employee. Now what? That one's going to be over in Calgary. So please subscribe to our newsletter, atbentrepreneurscenter.com. So that'll let you keep up to date on all the webinars we have going on. And so you can see all kinds of interesting articles and different complementary information, I would say, to a lot of what we learned here today. Thanks again, everyone, for joining. And of course, for Owais for all your time and knowledge. And hope you have a great rest of your day. And we'll catch you next time. Bye-bye.
Thank you, everyone, for making the time and for your enthusiasm and questions, and ATBA once again for inviting me to do this. Thank you.
Thank you.